What if you could predict today's SPX trading range before the market even opens? With VIX, VIX1D, and True Range, you absolutely can. And when you convert that volatility into a daily expected move, your ODTE strike selection becomes a data-driven process, not just a wild guess. Welcome to the ODTE Quant Lab. Today, we're going to break down the right way to interpret VIX1D, including a crucial detail that most traders get wrong. We will also show you how to combine it with True Range to create a solid expected move for your ODTE trades. By the end of this video, you will know exactly what VIX and VIX1D measure, why VIX1D covers volatility for today and the next trading day, how to calculate the expected move, how True Range shows you the actual movement, and how to position your credit spreads or iron condors outside of those key boundaries. Let's start with the basics. The VIX index measures the 30-day implied volatility of SPX options. Think of it as reflecting medium-term market fear, things like earnings cycles, macro uncertainty, or recession worries. VIX1D, which CBOE introduced in 2023, uses the same method but zooms way into the shortest possible time horizon. And here's the critical detail. VIX1D doesn't just measure today's volatility. To correctly model a variance swap, the VIX formula always needs to use two different maturities. So, VIX1D actually blends volatility from SPX options expiring today with SPX options expiring on the very next trading day. In practical terms, VIX1D is measuring the expected volatility from right now until the next SPX expiration. This includes today's trading session, the overnight session, and even the uncertainty leading into tomorrow morning. Now, let's turn that volatility into something you can actually use, the expected move. The formula is quite simple. The expected move is roughly the SPX price multiplied by VIX1D, which is then divided by the square root of 252. Volatility indexes are annualized. So, dividing by the square root of 252, the approximate number of trading days in a year, converts it into a one-day movement. You multiply that by the current SPX price, and you get the projected range. Let's say SPX is at 5,000 and VIX1D is at 16. 16 divided by 15-point-8-7, the square root of 252 is about 1%. 1% of 5,000 is 50 points. So, the options market is pricing in about a plus or minus 50-point move between now and tomorrow morning. The expected move is the forecast. True Range is the reality. True Range measures how far the SPX actually traveled. It captures the largest of three values, the session's high minus its low, the distance from the high to the previous day's close, or the distance from the low to the previous day's close. True Range gives you the real, unfiltered volatility, including any overnight gaps. And the relationship between the expected move and the True Range tells you everything you need to know. If the True Range is smaller than the expected move, the market was calmer than implied, which is fantastic for premium sellers. If the True Range matches the expected move, the volatility forecast was spot on. And your credit spreads need to be placed with proper margins. But if the True Range exceeds the expected move, it means implied volatility underestimated the real move. This is a warning sign. You either need to widen your wings or consider reducing your position size. True Range becomes your calibration tool. So, let's put this all to work. For iron condors, you want to place your wings outside the expected move. if the expected move is 50 points. You might sell call spread 60 to 90 points above the current price and put spread 60 to 90 points below, respecting that volatility forecast. For directional credit spreads, you combine your trend filter with the expected move. In a clear uptrend, you'd sell put spreads below the lower boundary of the expected move. In a downtrend, you'd sell call spreads above the upper boundary. A neutral, choppy marqué, iron casually work best. Then, you use true range to refine your positioning over time. If you notice that the actual move is consistently larger than what was expected, your spreads need to be pushed further out of the money. On the other hand, if the actual move consistently stays well inside the expected move, it means premiums are rich, and you might be able to tighten your wings a bit. The most robust ODTE framework combines all three elements: the overall trend direction, the expected move derived from VIX1D, and the validation from true range. This approach turns ODTE trading into a game of statistical probability, not a guessing game. Today, you've learned that VIX measures 30-day implied volatility, while VIX1D measures volatility from today through tomorrow's SPX expiration. You've also learned how the expected move converts that volatility into a usable price range, and how true range measures what actually happened. When you place your spreads outside that expected move and use true range as your feedback loop, you start trading with a statistical edge instead of pure emotion. For more quant-backed ODTE, tools like expected move dashboards, VIX1D analytics, and intraday volatility maps, be sure to subscribe to the ODTE Quant Lab. We measure volatility so you can trade with probability. See you in the next session.